Right now, one of the most talked about topics in the real estate world is mortgage rates. You might hear them linked to things like inflation or decisions by the Federal Reserve, but beyond the headlines, what do these rates actually mean? And why are they so crucial when it comes to owning a home? By the end of this video, you'll have a clear understanding of what mortgage rates are, why they matter, and how they impact you, whether you're looking to buy, sell, or already own a home. Aloha fam, Maddie here with Team Alakai, and today we're diving into a topic that every homebuyer, seller, and homeowner should be paying attention to: mortgage rates. Now, this is one of those terms that gets thrown around a lot in the real estate world, but let's be real, many people aren't entirely sure of what it means or how it affects them. And according to the latest study of the National Association of Realtors, a whopping 80% of buyers finance their home purchases, meaning most people who buy a home need to take out a loan, making it vital to understand mortgage rates. So let's break it down by starting with, what is a mortgage? A mortgage is a legal agreement between a borrower and a lender that allows the borrower to purchase real property. In this agreement, the lender gives the borrower the necessary funds to make the purchase, while the borrower commits to repaying the loan over a specific period. If the borrower defaults on the loan, the lender has the right to take possession of the property, which acts as collateral to securing the loan. All in all, a mortgage is a secured loan that allows families to enter home ownership without the need to invest a lifetime of savings into purchasing a home. So with that out of the way, let's go over, what is a mortgage rate? Well, banks and lenders aren't going to just loan out their money for free. They need to make a living too, and they do this by charging interest. So the mortgage rate is essentially the interest you pay on a home loan, shown as a percentage. And remember, when you take out a mortgage, you commit to not only repaying the original loan amount, what we call the principal, but also the interest on the remaining balance of the loan. So the mortgage rate plays a key role in determining how much extra you'll pay over the life of the loan. Now that we have a clear understanding on the concepts of mortgages and mortgage rates, let's talk about how mortgage rates impact you depending on who you are in the real estate game. For buyers, mortgage rates have a profound effect on what we refer to as your buying power. Essentially, buying power is the maximum amount you can borrow based on your financial situation and the current interest rates. When mortgage rates rise, it directly decreases your ability to borrow money, which means that you can afford less in a home and it will end up paying more in interest over the life of the loan. To illustrate how this works, let's take a look at a few examples. And for now, I really want to focus on how mortgage rates can affect your monthly payment. So for these scenarios, we're only considering principal and interest. These figures do not include other important monthly costs like property taxes, homeowners insurance, or potential homeowners associations or maintenance fees. We'll dive deeper into running the numbers in a future video, so stay tuned for that. Now, let's imagine you take out a $500,000 loan at an interest rate of 6%. In this case, your monthly principal and interest payment would be just under $3,000. But if rates were to increase by just 1%, bumping your mortgage rate to 7%, your monthly payment would jump to $3,327. It's over $300 extra a month. And if your goal is to, let's say, keep your monthly payment around that $3,000 figure, the reality is that you'd only be able to borrow around $450,000 instead. That $50K difference can mean having to settle for perhaps one less bedroom in your home, or no longer being able to shop in a particular neighborhood that you had your eye on. This highlights how even the smallest increase in interest rates can significantly impact the kind of home you can afford. For sellers, let me try to describe it to you like this. I like to compare the real estate market to a fish pond, the fish representing buyers and a piece of bread representing your home. The more fish in the pond, the more competition there is for your bread, and the faster it gets eaten up. On the other hand, when there's fewer fish, the chances of your piece of bread getting eaten up is much lower. So knowing the number of fish in the pond is crucial for developing a strategy to ensure your bread gets devoured quickly. But how do we determine the number of fish in the pond? That all comes down to mortgage rates. When mortgage rates are low, more buyers are able to borrow money, leading to an increased number of fish in the pond. So when you throw in your piece of bread, all the fish start swarming it. This is exactly what happened in 2020 when mortgage rates fell below 3%. The historic low mortgage rates drew numerous buyers into the market, prompting a surge in multiple offers on homes and triggering bidding wars. This in turn drove home prices to new heights over the next 2 years. And long story short, during this time, inflation had spiked over 9%, far exceeding the Federal Reserve's 2% target. This led the Fed to step in by enacting a policy that set mortgage rates on an upward trajectory starting in 2022. Since the latter part of that year, mortgage rates have hovered around 6 to 7%, eventually peaking above 8% by October 2023. So how have these increased mortgage rates affected the pond? Well, higher mortgage rates means that buyers must pay more in interest on their loans, making it much more difficult to afford homes they could have purchased just a couple years ago. For example, a home buyer taking out a $1 million loan at a 2.5% interest rate would see their monthly payment for their principal and interest around $3,900. In contrast, if they tried to take out that same loan amount at the peak interest rate of 8%, their monthly payment would jump to a little over $7,300. That's pretty close to double the original amount, making it very difficult for most families to afford to own a home. As a result, there are significantly fewer fish in the pond, so when you toss in your piece of bread, only a few might come forward, and it might take a while before they even decide to take a bite. You can see the rise in mortgage rates has dramatically reduced the number of active buyers in the market, making it crucial for sellers to adapt their strategies. With a smaller pool of fish vying for your piece of bread, patience and innovative tactics will be vital in capturing the attention of potential buyers. For homeowners, as many of you know, real estate is one of the best ways to build wealth over time, primarily because property values tend to appreciate. As years go by and you continue to pay down your mortgage, coupled with the natural increase of your property's value, you're building what we call equity. Equity is the difference between your home's current market value and the remaining balance on the mortgage. For example, let's say you bought your home for $500,000, and over the years you paid down your mortgage to $300,000. If the current market value of your home is now $700,000, your equity would be $400,000. However, many homeowners are unaware that they can even access this equity. By accessing your home's equity, you can fund various opportunities that can further enhance your financial situation. Homeowners often use their equity for purposes like making home improvements, consolidating high interest debt, investing in more real estate, or even financing education expenses. Several options are available to access your home's equity, such as doing a cash out refinance, home equity loans, and HELOCs. Each option offers unique benefits, but it's important to remember that tapping into your equity means qualifying for a new loan. This is why understanding mortgage rates is so vital. As we've learned, when rates have elevated, the interest you pay on borrowed funds increases, making it pricier to tap into your equity. On the flip side, when rates are lower, it means accessing your equity is more affordable. So knowing how mortgage rates impact your borrowing power help you determine not just how, but also when to access your home's equity strategically. And there it is. You made it to the end. I hope you found some valuable insights about mortgage rates. If you found this helpful, please like, share, follow, and subscribe. It lets me know that you're enjoying the content and helps the algorithm recommend my videos to others like you. Also, I'd love to hear from you. Comment down below and let me know, was this helpful to you? And what other topics should I cover? And while you're here, check out some of my other videos. They're all aimed at helping you on your path to home ownership. Thanks again for watching, guys. I look forward to seeing you in the next video.